What if the next recession isn't a nationwide collapse, but a targeted economic shock that hits specific Australian cities first and hardest? What if the warning signs are already visible? Higher mortgage stress, slowing population growth, exposed industries, and housing markets balancing on a knife's edge. In this investigation, we reveal the 10 Australian cities most at risk when economic conditions tighten further. Some of them are places you may live in, some are cities you may invest in, and some are communities that could face years of recovery if recession arrives. If you want to understand where Australia's economic pressure points truly lie, don't miss a single part of this breakdown. Australia is facing its most precarious economic landscape in decades. While the nation technically avoided a recession through 2024, the economy did enter a per capita recession in 2023, where GDP per person contracted despite total GDP growing slightly. This discrepancy signals a deeper structural issue: strong headline numbers masking the reality that most households are going backwards. The Reserve Bank of Australia raised interest rates from 0.1% to 4.35%, the fastest hiking cycle since the early 1990s. This aggressive tightening was aimed at controlling inflation, but its side effects are profound. Mortgage pressure is now at historic highs, discretionary spending is falling, and small businesses are reporting rapidly declining cash flow. These forces don't impact all cities equally. Some places possess economic diversity and resilience. Others resemble a house of cards, built on single industries, or inflated property markets vulnerable to rapid correction. To understand vulnerability, experts examine 4 key indicators. 1. Industry concentration risk. Cities dependent on a single sector, tourism, mining, steel production, are far more exposed during downturns. When the core industry contracts, job losses cascade through the entire community. 2. Housing market fragility. Pandemic-era property booms inflated regional prices far beyond local incomes. When interest rates stay elevated, these markets face significant correction risk. 3. Unemployment trends. Cities with persistent structural unemployment often experience deeper recessions and slower recoveries because displaced workers have fewer alternatives. 4. Population stability. Regions that lose residents during downturns can enter multi-year declines as demand for housing and services evaporates. These vulnerabilities are already emerging in the economic data. But to understand the scale of the challenge ahead, we must examine the cities most exposed. Not because they will collapse, but because they carry quantifiable risk factors that policymakers and residents cannot ignore. The following sections present the 10 cities most at risk, starting with Cairns, a tourism hotspot where economic fortunes rise and fall with visitor numbers. Number 10. Cairns, Queensland. Cairns is a tropical tourism engine, yet that strength is also its greatest vulnerability. An estimated 60% of its economy relies directly or indirectly on tourism, making it one of Australia's most industry-concentrated cities. Unemployment traditionally sits above the national average, often 5 to 7%, driven by seasonal work and dependence on visitor spending. During economic downturns, tourism is the first household expense to be cut, leading to immediate job losses across hotels, restaurants, tour companies, and transport operators. Rapid property price increases during the 2020-2022 pandemic created another exposure. Low incomes plus high housing costs, a combination that becomes dangerous when mortgage stress rises. Cairns is resilient in the long term due to the Great Barrier Reef's enduring appeal. But during recessions, it is one of the first cities to feel the shock. Number 9. Townsville, Queensland. Townsville's economy is more diversified than Cairns, yet it suffers chronically high unemployment, often 6 to 8%, and has been labelled one of Australia's most persistent job market weak spots. Its primary employment pillars include defence, mining services, port logistics. The challenge is cyclical exposure. When global commodity demand slows, especially from China, mining service jobs disappear rapidly. Townsville also struggled with housing oversupply in the 2010s, and although the market stabilized, it remains vulnerable to renewed downturns. Limited population growth compounds the issue. When jobs disappear, residents often migrate elsewhere, slowing recovery and weakening housing demand. In a recession scenario, Townsville could easily enter double-digit unemployment. Number 8. Darwin, Northern Territory. Darwin is defined by boom-bust cycles, each tied to major resource or defense projects. When construction phases end, thousands of workers leave immediately, creating sudden demand shocks in housing and retail. Darwin's extreme price movements tell the story. Median property values dropped roughly 30% after the last major boom ended. The city depends heavily on defense, government, resource projects, construction. Darwin's isolation limits alternative employment options. During downturns, residents often relocate to larger capitals, triggering population decline, a dangerous cycle that pushes housing values even lower. Darwin's long-term prospects remain linked to strategic defense investments, but its boom-bust volatility makes it one of Australia's most recession-sensitive capitals. Hobart's vulnerability is centered almost entirely on the housing market. From 2016-2021, prices rose 80–90%, the fastest increase among all Australian capitals. But the city's incomes did not rise at the same pace. Hobart's median household income remains significantly lower than mainland capitals, making the market fundamentally stretched. Key risk factors include expiring fixed-rate mortgages, leading to payment increases of $501,000 per month. Potential for price corrections of 20–30% in high-growth suburbs. Limited economic diversity, with tourism, government, and education dominating. Hobart's extreme rental shortage may flip if population growth slows during recession, shifting stress from tenants to homeowners. Northex, Geelong, Victoria. Geelong represents a city in transition. Once a manufacturing powerhouse, it suffered major shocks with the closure of Ford in 2016 and Alcoa prior to that. These events eliminated thousands of secure, well-paid jobs. Today, Geelong is rebuilding around healthcare, education, port logistics, professional services. However, transitions take time. Many workers displaced from manufacturing have not found equivalent employment. The city also became a spillover market for Melbourne during the pandemic, pushing prices higher, creating exposure if Melbourne's economy slows. Geelong's vulnerability is twofold: cyclical employment risk and dependence on external buyer demand. In a recession, both pressures could hit simultaneously. Number 5. Gold Coast, Queensland. The Gold Coast is large, over 680,000 residents, but economically fragile. Its prosperity is tied to tourism, construction, retail, hospitality, entertainment. Each of these sectors is highly sensitive to consumer confidence. When households cut back, the Gold Coast slows immediately. The city also has one of the largest concentrations of casual and part-time workers in Australia, jobs that disappear rapidly during downturns. High-rise development has created risks of apartment oversupply, particularly in investor-heavy suburbs. If tourism declines and construction projects stall, the Gold Coast could face a sharp rise in unemployment alongside property value corrections. Number 4. Launceston, Tasmania. With a population of 110,000, Launceston is simply too small to absorb large economic shocks. Its economy relies on agriculture, food processing, manufacturing, healthcare, and tourism. These sectors offer stability, but lack scale. Launceston faces higher than average unemployment, lower median incomes, youth out-migration to mainland cities, limited industry diversification. Pandemic-era housing price increases further worsened affordability, creating heightened vulnerability to job losses. In a recession, population decline becomes a real risk. When residents leave, demand for housing collapses, which then reduces business revenue, creating a difficult downward spiral for smaller cities. Wollongong's economic identity is tied to BlueScope Steel, one of Australia's largest industrial employers. Steel production is highly cyclical and vulnerable to global downturns, especially falling demand from Asia. When construction slows, steel orders decline sharply. Wollongong also functions as an affordable alternative to Sydney. Its property market relies heavily on Sydney workers and investors, creating dependence on external economic conditions. If BlueScope reduces output or cuts jobs during recession, Wollongong could face immediate job losses, housing market weakness, declining small business activity. The city has a strong university and growing healthcare sector, but its industrial concentration remains a structural weakness. Number 2. Newcastle, New South Wales. Newcastle is deeply connected to coal exports, with the port of Newcastle serving as one of the world's largest coal terminals. Coal is in long-term decline due to global energy transition, yet still employs thousands across the Hunter region. During a recession, coal demand drops, commodity prices fall, Marginal mines close. Port activity contract. Newcastle knows industrial hardship. BHP's steelworks closure in 1999 devastated the region. While the city is diversifying into education, healthcare, and potentially renewables, the transition remains incomplete. Additionally, Newcastle's housing market has been fueled by Sydney buyers. If Sydney weakens, Newcastle feels the ripple immediately. Number 1. Adelaide, South Australia. Adelaide is Australia's most vulnerable capital city. Not because it lacks diversity, but because its economy has grown slower than those of Sydney, Melbourne, or Brisbane for decades. Unemployment has historically been 0.5 to 1.5 percentage points above the national average. Its major vulnerabilities include the collapse of automotive manufacturing, Holden closed 2017, Mitsubishi 2008, slower population growth, fewer high-wage job sectors, limited private sector expansion. Adelaide has strengths: defense contracts, universities, wine exports, but these do not fully compensate for declining traditional industries. During recession, Adelaide typically experiences sharper unemployment spikes, slower housing market recovery, reduced business formation. Its affordability helps soften the blow, but cannot fully offset structural risks. Understanding vulnerability requires understanding the sequence of economic damage during recession. Experts identify 4 primary phases. Phase 1, interest rate shock already happening. Mortgage stress is growing rapidly nationwide. For cities with low incomes, Hobart, Launceston, Townsville, the impact is deeper. Expiring fixed-rate loans are creating payment surges of $500, $1,000 per month. Households with limited savings begin cutting spending immediately, reducing demand for local goods and services. Phase 2, job losses in discretionary sectors. Tourism, hospitality, retail, and construction shed jobs rapidly when consumer confidence drops. Cities hit hardest: Cairns, Gold Coast, Hobart, Townsville. Mining and industrial cities like Newcastle, Darwin, and Wollongong face their own shocks when global commodity demand falls. Phase 3, housing market correction. As unemployment rises and mortgage stress continues, forced sales increase. Cities with the highest correction risk: Hobart, extreme price growth; Gold Coast, investor-heavy apartments; Geelong, dependence on Melbourne buyers. A 20 to 30% decline, while not guaranteed, is possible in highly inflated markets. Phase 4, business closures and population decline. As spending plummets, small businesses begin to fail. In smaller cities, Darwin, Launceston, Townsville, this can trigger a feedback loop. Businesses close, jobs disappear, residents leave, housing demand falls, more businesses close. This spiral is the greatest risk facing Australia's most vulnerable regional economies. Australia's next recession, if it occurs, will differ from past downturns. What's different this time? Household debt is at record highs. Australians hold some of the highest debt-to-income ratios globally, magnifying interest rate impacts. The RBA has limited room to cut. Inflation constrains aggressive rate reductions. China cannot stimulate demand. Like 2008, China's property downturn reduces demand for iron ore, coal, LNG, hurting cities like Newcastle and Darwin. Government fiscal space is tighter. Massive pandemic spending limits future stimulus. Despite these challenges, Australia also has strengths. High immigration supports long-term housing demand. A stable banking system reduces financial crisis risk. Strong commodity export base provides income flexibility. Cities are actively diversifying their economies. The message is not alarm, it is awareness. Residents should understand their city's economic structure, industry reliance, and housing market exposure. Businesses should manage risk carefully. Homeowners should prepare for interest rate pressure. Investors should consider long-term fundamentals rather than short-term cycles. The 10 cities in this report, Cairns, Townsville, Darwin, Hobart, Geelong, Gold Coast, Launceston, Wollongong, Newcastle, and Adelaide, are not doomed. But they are statistically more vulnerable during national downturns. Knowing this helps individuals make better decisions about where to live, work, and invest. Australia stands at a pivotal moment. The question is not whether economic pressure exists, it is which communities will feel it first.